Today's presentation is on federal income taxation of real estate transactions. My name's Cory Bilodeau. I'm a partner at McLaughlin Quinn. I run the tax planning department and generally what I call transactional tax law. That's where my focus is. We'll focus on capital gains planning for real estate developers, 1031 exchanges, how the net investment income tax applies to rental real estate, and the passive activity rules. Where appropriate, we will talk about recent court decisions or regulations that have come out. There have been some final regulations that were promulgated and on 1031 exchanges a year or so ago. And then there have been some court cases in the capital gains versus ordinary income for developers. And then there have been there's always passive activity cases that come out. We'll talk about the passive activity rules as they apply to real estate, in particular rental real estate, and some of the traps that I see. We'll sprinkle in some partnership issues because obviously that a lot of real estate is held in partnerships, although there's a separate course program through BTI on partnerships. I think it's in the beginning of December that I teach. And the way I kind of approach these presentations is I do a lot of work with CPA, some of you who are attending the program, and whenever a question comes up, I try to incorporate it into my materials, because I would think that if it's coming up with one CPA, it's coming up with others as well. And so something basic like 121 and the capital gain exclusion for someone's principal residence. However, there are some quirky rules, particularly as it applies to non-qualified use, and then former residences of spouses and divorced couples that are somewhat change the rules a little bit on that 2 out of 5 year requirement. And then there's always the question of what is someone's principal residence. The exclusion applies to a principal residence that has been owned and used for 2 out of the preceding 5 years. So there's just 2 out of 5 year test that the taxpayers have to satisfy in order to, and there's 2 prongs to that. There's the ownership part and there's the use part. And then we have some different kind of tweaks on those rules for partial satisfaction if there's unforeseen circumstances, health reasons, change in employment, where the exclusion's available partially for taxpayers. And then we obviously have the exclusion, some quirky rules again for residences, principal residences that were applied to divorced couples. One of the things, just to make sure that everyone understands, is that there's how do you determine someone's principal residence? And again, most of the time it's straightforward, but there can be times where people have multiple homes and maybe they spend time at both. And the easiest way to think about it is if you do have any experience in domicile planning under state law, then you're aware of the rules, the tests that the states apply in determining someone's domicile, not so much their principal residence, although that does certainly apply. It's a little bit different, but the typical factors are ones you would think of as where does someone spend most of their time? Where do they receive mail? What's the address they used on their estate planning documents? Where do they vote? By the way, today's voting day, so make sure everyone votes if you haven't already. And where's your driver? What do you have as an address on your driver's license, your passport. All of those things come into play. And the other odd rules that, or some of them that you need to be aware of is that there's the periods of non-qualified use don't count. And what that means is taxpayers would sell their principal residence, move to their vacation home, and then sell the vacation home, and they'd take advantage of the full exclusion amount. And Congress didn't like that. And I think it was back in 2009 or so. It was technically 2008, the bill passed. The Congress changed the rules to say that periods of non-qualified use after January 1, 2009 limit your ability potentially to take the exclusion when you sell your home. And for a single taxpayer, it's $250,000. For a married taxpayer filing jointly, it's $500,000. The interesting quirk in this law is that the limitation applies to the gain on the sale of your principal residence. It doesn't apply to the exclusion. When you run through the calculator, just to use kind of a basic example, if I rented my property for 2 years and then I moved in there for 8 years, and so my total ownership was 10 years, total use 10 years, then 20% of my gain, so the 2 years of non-qualified use divided by the total use of 10 years, subject to tax. It can't be excluded under 121. However, depending on how large the gain is, an example would be, what if I had a $1 million gain? Well, the first thing you look at is, okay, well, how much of the gain is excluded? And I'm a single taxpayer. It's $250,000. Well, I've got $1 million of gain. That means $750,000 is reported. That includes the $200,000 that is disqualified because of the non-qualified use, not allowed. So depending on the size of the gain and the amount of non-qualified use, it may not actually impact your clients. The longer, obviously, the property is owned and used as a principal residence, that non-qualified use portion shrinks because over time, the ratio just gets smaller because it's non-qualified use is periods of time prior to that 5-year period when you sell.